I'm going to show you a modification to my moving average cross strategy that might make it much more powerful. Be sure to watch. Hi, this is Tim from TradingStrategyGuides.com. Come on, you guys. You got to be serious and disciplined if you're going to become successful traders. Monday, I asked you to pick one or two of your 2020 goals and outline the steps you're taking to achieve those goals. I got one response. I understand you're not wanting to share all of that stuff publicly, but at least let me know you've done it. Then let me know what I can do to help you to achieve those goals. The sole reason that I take the time to do these videos is that I want to share what I've done in the hopes of helping others to do the same. Let's do this. Give me your comments below. I've showed you the moving average cross strategy and we've used it to make a little profit. Today I'm going to show you a nice modification that I've recently discovered that might make it much more powerful. I also want to show you a great setup on platinum. I love trading precious metals. First thing, we'll talk about the open trades and a blown setup. Then later on, a trading maxim from one of my favorite coaches. It's hump day, so let's get over it. Remember to click the subscribe button and hit that bell so you won't miss any cool stuff. Okay, let's look at the trades. I'm still waiting for this US dollar Mexican peso weekly setup to hit the first target. Looks like it's pushing through and making a new low right this very second. So a breakdown here could definitely drive us all the way to the target. We'll see. The Euro Swissy is pushing down pretty hard right now. Here's the point that makes me a little uncomfy about waiting for this parabolic SAR to get down here so that we can move our stop loss. The stop loss is currently at break even right here, 108.96-ish. And the price is pushed way down here. Had I been following stops manually, I would have put the stop right here at the first target already. But I'm sticking to the rules on this one and waiting for the PSAR before I move the stop down. The New Zealand Canadian did just the right thing and it hit our target earlier today. Half of the trade is now booked and the stop is set at break even. Price moved up here after hitting the target and almost hit our second half stop, but it stalled a couple of pips from it, so I'm still in this. As with the Euro Swiss, I'll wait for the PSAR to come down here before we move the stops further down. The Australian dollar, Canadian dollar has totally blown this ascending triangle that I showed you a couple of weeks ago. So what now? Well, as I've said before, the resistance level right here at 91.42 is still as strong as it ever was before the uptrend was blown. So I still like a break of that level as long as the volume and volatility continue to decline. Well, I'm not seeing that right now. So we'll have to keep an eye on it. This huge bearish move right here had a whole lot of volume behind it. But it looks like the stop down here at this level has got a lot of volume behind it. I'm not ready to look at this as a trading range just yet, even though this is stopping right here at this point, but I don't want to take a short on a close below that level. So I'm going to watch this one for a little while and we'll see where it goes. I am still definitely interested in trading a close above the 91.42 level, however. Before we talk about the platinum trade setup, let's talk about a possible modification to the moving average cross strategy. Today I want to show you the exponential moving average strategy. This was presented in the Trading Strategy Guides blog a few months ago and somehow I missed it. I like the looks of it and will be adding it to my list of strategies to test. I want you guys to do the same and let me know in future comments what results you get. A few weeks ago we talked about the difference between the simple moving average and the exponential moving average. What it comes down to is this. The exponential moving average, or EMA, responds more quickly to price movement because it puts more weight on the recent closing price. For you mathy geeks out there, here's the formula for the EMA. I don't think I've ever met a trading platform that didn't have the EMA indicator built into it. Sometimes it's simply listed as moving average and then has a setting allowing you to select the type of moving average. Here's the exponential moving average strategy. Step number 1, plot the 20 and 50 EMA on your chart. On TradingView, it's as simple as this. Click Indicators, click Built-ins, scroll down to Moving Average, look for Moving Average Exponential. I've clicked the star here because it's one of my favorites. And just click on that. And it will appear up here as an EMA 9 by default. At that point, you click on the settings, select the color that you like, pick a green color here. And I also like to use double thickness lines because I have old eyes. And then over here on inputs, make it 50. And that's how you add the 50 EMA. Now I already have the 20 EMA on my chart because that's what I use for the MAX strategy. And you may have noticed that you can turn these indicators on and off or make them visible and invisible just by clicking the show or hide button, like so. I'm going to be showing you the steps for a buy trade. Then we'll talk about a sell trade. So the next step, number 2, wait for the EMA crossover and for the price to trade above the 20 and the 50 EMA. So you start by looking for the 20 EMA, which is red in this case, to cross above the 50 EMA, which happens right in here. That satisfies step number 2. Step number 3, wait for the zone between the 20 and the 50 EMA to be tested at least twice, then look for buying opportunities. Okay, so here's the 20 and the 50 zone, and we want to see prices test this zone right in here. Now remember the maxim, a line is never just a line, it's always a zone. A test of this zone between the 20 and the 50 can constitute something as simple as a touch of the line right here, and it can also constitute a push through the line right here. Now in my opinion, you have to draw a line somewhere, so to speak. So I would say a close below the 50 might negate the strategy. So this was very close right here. This comes down to judgment calls in a lot of cases. And that brings us to step number 4, buy at the market when we retest the zone between 20 and 50 EMA for the 3rd time. So you can see test number 1, test number 2, here is the 3rd test, and this is where we're going to buy at the market. Of course, you don't want to buy it down here while it's still in here because it could just push on down and go this way. The blog suggests buying when it crosses back above the 20. That works. It'll reduce your risk because you can keep your stop smaller. I personally prefer to wait for the candle to close above the 20 EMA. Since I would trade it on daily candles, I would only have to watch it for a few minutes a day to see if it complied. So I guess I do that out of laziness. I don't know. Otherwise, I'd have to watch the charts all the time. You know, of course, this is just personal preference. Whatever you choose to do, be consistent and always test, 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 test. Okay? At this point, how you manage the trade from here on out is up to you. I would use my standard trade management method consisting of a stop loss at 1.5 times the ATR and a first target of 1 times the ATR, taking half off at the first target and following stops on the remainder. The blog suggests another method, and I'll put the link to the blog below so you can check it out. So we just described a buy trade. A sell trade would be the opposite, of course. The 20 crossing the 50 to the downside, price crossing below both, and the 2 retests of the level, and then the sell signal would be the crossover or close below the 20. The modification to my moving average cross strategy that I really like in this strategy is the 2 retests of the zone between the moving averages before entering the trade. That might serve nicely to filter out consolidation periods and make sure we have a nice trend before entry. Up until now, I've been watching for a decent separation of the moving averages before entering, but that's pretty subjective judgment call, and I know judgment calls are tough for new traders. I'll be testing that feature of this strategy in my MAX strategy to see how well it works. I will let you know my results. Okay, let's take a look at the platinum trade setup. Looking at a daily chart of platinum against the US dollar, we see a nice ascending triangle. An ascending triangle consists of a strong resistance level. Now, I've fudged this level a little bit. The actual line is probably down here at 996 or so, but since that's only $4 from 1,000, I moved the resistance up to 1,000, which gives us enough room for the price to hit our first target without having to overcome a strong psychological level. I did find these wicks very interesting here, since they came on fairly significant volume. A couple of them looked like there was a lot of volume behind the moves to the upside, and this one looked like the volume was a downside move right here. So here's a little trick I've showed you guys before, but I want to share it again for the new subscribers. If you have a real wiki candle like this one right here, a pin bar if you will, how do you know whether the volume is in the original up move or in the arresting of the up move that caused this wick? Well, you do that by drilling down to the short time frames and seeing where the volume is during the course of this daily candle. Here's the hourly chart. These yellow lines right here represent the days of the top 3 candles in the move, from the first hour of January 2nd to the last hour of January 6th. This tells us part of the story. You can see that a huge amount of volume went into arresting the up move on the 6th right here. But what's this big volume right here on this pin bar? The pin candle is only green because the close is higher than the open, but it opened and closed at almost the dead bottom of the candle. This happens to be the 1700 hour candle on January 5th, and that's US Central Time, or 1 hour behind New York time, by the way. So this was about the time the market opened. Let's drill down further and see what's going on. Here's the 1-minute chart, and it tells us the story. There was significant volume on this up move right here, big volume on these 2 candles right here, and even more significant volume on this candle right here. Now, obviously, this candle has a lot of wick down here. So my conclusion is that a real knife fight was happening here. TradingView will allow me to drill down even more to a 1-second chart, but I think you understand the thinking behind this. You can get a real understanding of trader sentiment by using this trick. In any case, a preponderance of traders appear to want to keep this from breaking this resistance level up here, suggesting this is a very strong level. Going back to our daily chart, another important element of an ascending triangle is the ascending price lows down here that form an uptrend, indicating a reluctance of traders to allow this to go much lower. As price winds up in this triangle, more and more pressure comes to bear on the resistance level, which we expect will eventually break explosively. In addition, we want to see declining volume and volatility down here. You can see that both of them jumped a bit right here and right here during all this drama right in here at the resistance line, but I expect to see it resume its decline in the next few days. So here's our trade plan. We'll buy a daily candle close above the triangle or above the 1,000 level. On the breaking candle, to enter a full-size position, I want to see this volume bar reach up to the moving average. If it doesn't quite reach the moving average, but does at least reach 75% of the average, I will open a half-size position to reduce risk. You can calculate the percentage by dividing this volume number by this volume average, and you should get 0.75. If you don't get 0.75 on that, you need to stand aside on the trade. The stop loss will be 1.5 times the ATR, and the first target will be 1 times the ATR. So let's say that this candle breaks right here and closes right here. That will be your entry. On that day, you want to look at the ATR, multiply it by 1.5, measure that amount below the entry to get your stop loss, measure 1 ATR above the entry to get your first target. If after entering the trade, get a candle that closes back inside the triangle, we'll take the loss right then and not wait for it to hit the stop loss. Our intention is that a breakout above the triangle should be explosive and hit our target fairly quickly. If the momentum goes away, we want to shut the trade down without taking a full stop if possible. When price hits our first target, we will close half the position for profit and set the stop loss to break even on the remainder. We will then follow stops as price moves in our direction until the market takes us out. Now, these two rules are the very definition of cutting your losses and letting your winners run. Typically, I do this using 2 positions. The first position has a stop loss and a take profit. That position will close automatically when the first target is hit. The second position will only have a stop loss, and that's the position that will be allowed to run. When the first target is hit, we will have to manually move our stop loss up to break even on the second position. I will only risk about 2% of my account on each trade. And that's today's setup on Platinum. Remember, I've said this several times over the last couple of weeks. Trading can be whippy due to low liquidity for a few more days until everyone is back at work from the holidays. We are probably approaching that point now, so still be careful. Always follow your rules strictly. Also remember, my intent here is to tell you how I manage these trades. If you've already got a good trade management plan, use it. Things that work for me may not work for you. You have to understand your own mind to find the best strategies for your trading. And that's my intent for the trading maxims, to help control my emotional impulses and keep me on the straight and narrow path. A maxim is a general truth, fundamental principle, rule of conduct, or proverbial saying. The purpose of my maxims is to motivate me to discipline in trading as well as other areas of my life. I suggest you start your own list of maxims, things that you can say to yourself while you're trading or doing life to make sure you always do the right thing. Feel free to borrow from my list. And today, another quote from one of my favorite coaches. Tim's trading maxim number 60, staying in a negative mindset will undermine confidence. Living in the past is a liability that will diminish future opportunities. And this is a quote from Ben Bergeron. You may remember me telling you that I had a lot of quotes from Ben Bergeron, right? He's very prominent in the CrossFit community and coaches several of the top CrossFit Games athletes. You guys know that I like to stress the importance of mindset and psychology in your trading. You can't let prior losses or wins affect your mindset on your current trading. Prior wins can affect you with euphoria, the mindset that you can't lose. That mindset is even more dangerous than the fear mindset, but either mindset is wrong. You have to be like a machine. If the trade meets the criteria for an entry, whatever your criteria happen to be, you've got to enter it and follow all the rules. What happened in the past stays in the past. You move on from this point forward. Remember our daily platinum trade plan here. We're going to buy a daily candle close above the ascending triangle or above $1,000. If the volume is not quite average, go half size as long as it's at least 75% of the average. Your stop loss is 1.5 times the ATR, and your first target is 1 times the ATR. And remember to click the link below to the trade management video for more details. And sign up for my free Trading Picks email list so you don't miss any of these great picks. I send out 3 or 4 trading picks a week from all different markets, and you'll get to see them first. And the best thing is, it's free. I'll put the link below this video. Be sure to come back to Trading Strategy Guide's YouTube channel every week on Monday, Wednesday, and Friday at 3 p.m. U.S. Eastern Time for my new videos. Don't hesitate to ask any questions you may have. I'll either answer your question right in the comments or in a training video or both. And remember, the only stupid question is the unasked one. Once again, guys, remember, I want you to talk to me. Talk to me. Let me know the steps you're going to take to achieve your goals this year, or at least let me know that you made some steps toward achieving your goals, and make sure you tell me what I can do to help you. Be sure to comment below. As always, thanks for watching, thanks for subscribing, and don't forget to hit the thumbs up below. Have a great hump day, and I'll see you on Friday.